Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim, and belated happy Thanksgiving.
May the turkeys be with you. Ross, housing starts down in September. They estimated 210,000 would happen, 189,000 dead. What does this tell us about the housing market, and does this mean we might have a shortage of houses in the future?
Now, there's an interesting set of questions, Jim. Does it mean we're going to have a shortage of houses in the future? Yes. Yes. This is a black and white issue. The Canadian housing stock has not been built at a rapid enough pace over the last 25 years to keep up with demand. Now, we don't see a lot of homeless people in Canada. Now, I don't mean people who, through, real hardship, are on the streets. I mean families that are kicked out in the streets because there's not enough houses, or new immigrants coming into our country where people aren't able to find houses for them. What I'm talking about in terms of the housing stock growing, you're back in the 1990s, Jim, when the last recession hit. Canadians turned to new homes. And when they turned to new homes versus resales, it was happening at a time where there was a pent-up demand for single detached homes. When those single detached homes are purchased in the new housing market, it means there's jobs that are created because those homes have to be built. For those homes have to be built, all of the components of the home have to be manufactured somewhere, whether it's a nail or whether it's the lumber to put up the house. You have employment at your local municipality, surveyors, lawyers, developers, bankers. All of these people are involved in the process when it's a brand new home. You don't have that kind of employment when the money is being sucked up by the resale housing market. And this is really what you're looking at today. So when you're looking at the numbers today that are coming out, they're talking about British Columbia falling. First of all, if we go back to the last shows over the last couple of months, you would have heard me talking about this misuse of seasonally adjusted numbers. Well, housing starts are one of those seasonally adjusted numbers that an economist or housing analyst should never use. Seasonality is true in terms of the builders are going to start more houses in the spring than they are in the middle of winter, but the overall market, how it works, you can't. It's cyclical in nature that doesn't follow a calendar year. So your seasonally adjusted numbers really mess you up at certain times in the market, which is why our firm never uses them. We don't have to use them. So I'm telling economists and housing analysts out there, you do not have to use seasonally adjusted numbers. I'm just telling you, but I'm also telling you at the same time, we don't use them. So your falling sales, which are being commented on in the news today, will be a seasonally adjusted number released by StatsCan or CMHC. We don't use that. We use the actual numbers. So if you look at the actual numbers, you see that they have fallen, but they also have fallen the four previous months. So today's result was not surprising. Where the problem happens, Jim, is that let's say for the sake of the argument that 30% fewer new homes are built in Canada next year. Well, that means 30% of the jobs that resulted from the construction of those homes, from the clearing of the land to the designing of it by the architects to the manufacturer of nails, the manufacturer of the appliances, the asphalt that covers the street that's built, the pipes that are put into the ground, the hydro towers or the hydro lines that have to be run, the cable lines, your television that has to be run, from the smallest minute detail that causes employment in your country is down by 30%. And this is where the problem happens when we read these things in the newspaper and we're thinking, what are you guys talking about? Why are you happy that mortgage debt, for the sake of the argument, is decreasing? You know, Canadians prefer brand new homes, Jim. If a Canadian is given the choice, Canadians prefer new homes. If you look at sales trends over the last 50 years, home buyers disproportionately have chosen newer homes. The government, by trying to maintain, we're not going to grow, we're not going to grow into the green space. We're not going to grow over our agricultural land in a municipality, versus saying, okay, never mind, we're going to leave the agricultural land out in the suburbs somewhere. When the governments don't understand that you have to build your housing stock to keep employment going, to keep your population moving through the old housing stock, all of the jobs, all of the GDP, everything that's created by new houses, and they believe that it's better for things to slow down, it makes no sense from our perspective, Jim. We know the employment that is created from the manufacture of a single new housing unit, whether it's a condo high-rise or single detached. We know that single detached homes create far more jobs per dollar spent by the home buyer. More jobs. It also allows your housing stock to be far more diversified, because when you're talking about single detached homes, it means smaller builders can get a piece of the pie. More Canadians can get involved in the housing construction industry, versus a condo high-rise, where it's always only the big corporations now that can make that happen. What I will make a comment about the housing starts, Jim, though, is this. The reason British Columbia has lower housing starts being announced after Thanksgiving is because your housing market began to correct in the fall of 2016. The reason why we say these economists, these housing analysts, don't know how a housing market functions is being recorded right now by them being surprised that housing starts were declined. When listeners on to this show can go back to the fall of 2016, where we told you the housing market was correcting, which means 18 to 24 to 36 months later, housing starts will fall because those sales didn't take place back in 2016 in the new housing market. The evidence is there. We gave it right here on the show. What can your listeners gain from this? What your listeners can gain is anything in the economy that is tied to the housing market, household consumption, putting a roof over your head, like building more homes. Those changes that take place in the number of homes that are going to be built in the future are generally 2 years, that they happened 2 years ago. What is happening in the marketplace right now in 2018? You're not even going to read about it till 2020, 2021, 2022. In some cases, with the condo market, it can be 5 to 7 years. You need to understand how the housing market is going to flow going forward in order to make your investment decisions in the housing market today. What you're reading today in the newspaper, as we've said in the show before, these details were all decided years ago. And in the case of these new housing starts, it was the fall of 2016 when we announced on your show that the housing market in our metrics had already recorded a 26% reduction, which you're now hearing about all over the place in Vancouver. That predicated your declining housing starts that were going to be announced 2 years later.
We'll have more with Ross Kay right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the Pink, symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ross Kay. Ross, they're talking about deleveraging happening in Canada. What is that, and should we be concerned about it?
Well, every single Canadian should be worried about it, because what you don't read in the newspapers, what you don't read from the economists, what you don't read from the analysts, is what the consequence of a deleveraging debt portfolio for the nation has on net wealth. So this is something that everybody can probably understand. Housing prices, net wealth, cannot go up unless more mortgage debt is booked. It is a mathematical impossibility. People buy homes on leverage. And without that leverage, the only alternative is for housing prices to decline. Declining housing prices mean, for the vast majority of Canadians, less net wealth. Less net wealth means you have less money to spend. It's the accessible cash that you have available to go out and purchase a car, or to purchase a new mattress for your home, or to take a holiday. That money is no longer available. Whether that money was available through borrowing it or borrowing against your home, whatever you want to look at it, that money is no longer available. We don't look at deleveraging. So our firm doesn't use the term deleveraging because we think it's one of those words where the consumer, when they hear it, oh well, yeah, that makes sense. Yeah, if we deleverage, in other words, we're going to lower the amount of debt that Canadians have, it means our nation is going to be better off. Well, folks, that has never, ever happened. As your nation of homeowners deleverages, which to us means they concentrate on paying down their mortgages versus buying other homes besides working up the property ladder. Fewer and fewer homes sell. Without enough homes selling, prices begin to fall. As prices begin to fall, you have net wealth declines. Net wealth declines means people can't go out and spend as much money as they're spending now. Job loss happens. If that happens at the same time, Jim, as rising interest rates, which we haven't seen for 35 years, we are starting to see now, then you get the double whammy. You get an entire demographic of Canadians who have never lived at a time when interest rates were rising. They don't have the homeownership financial capacity, the understanding of how homeownership works, to navigate that road. The result is a house price correction, and the result is a recession. So when we're hearing these comments about deleveraging, we look at it this way. If enough new mortgages are not booked each month to maintain the housing stock at the current pace of how the housing stock is being built, then you are going to see declining net wealth of the nation. The entire nation will lose net wealth. People will not be able to borrow money from their home to invest in the stock market. So for the financial advisors who are listening to the show today, don't think you're going to get off the hook. There is another myth that when people quit spending money in their homes, they start spending in the stock market. That's a myth, because the truth is people who have a higher net wealth, i.e. house price illusion, are more free to invest in other asset classes, whether it's stocks or bonds or life insurance policies for that matter. So when we're talking about deleveraging, what we're actually talking about is a lowering of the wealth of your nation. The problem that we have is this. Governments do, if you go and try to find somewhere what I just said in an academic textbook about how deleveraging destroys the net wealth of a nation, you will not find it. It doesn't exist. And this goes back to the other things we said in the show before, Jim. For us, the world is round. For economists, when we're talking about the housing market, the world is round. For economists and housing analysts, they think the world is flat. They really don't understand that as we deleverage, in other words, as the mortgage book, the new mortgages being booked decrease, the net wealth of your nation decreases. And there is no way for an economy to navigate that. We would have to start exporting at such, well, it would have to be a historic level of increase in exports of this nation to make up for a leveraging in the housing market, mortgage debt. When your interest rates are as low as they are in the fall of 2016, as when they were as low as they were, we were already deleveraging our mortgage debt naturally at a historic rate. Canadians were making historic principal payments on their mortgage. Never before have Canadians paid down their principal as rapidly or to the amount that they were paying it down each month. In the ensuing year and a half, 2 years, Canadians continue to pay down that mortgage debt, but they're not booking enough mortgage debt to allow people to keep moving up the property ladder. That means your net wealth decreases. So, just so all your listeners understand, when all of these rating agencies, everyone else has been out there talking about Canada's debt to income ratio, debt to GDP, as we talked about on previous shows. When those numbers decline, net wealth falls. This is a black and white housing market math fact. We are going to see the net wealth. We are already seeing it all over the country. We're already seeing it, Jim. It is historic net wealth has been lost in the last 1 year and the last 2 years in some provinces. Well, the last 3 years in other provinces. Montreal is the only one where net wealth is still increasing right now, because net wealth is an illusion. It is created through house price gains. As you deleverage, net wealth decreases. The wealth of your nation decreases. So, yes, are Canadians paying down their mortgage debt? Yes, but they're not paying it down any quicker than they were 2 years ago. They're paying it down at the exact same pace. What's different is they're not booking enough new mortgages because they're not working their way up the property ladder. And when Canadians don't work their way up the property ladder, net wealth declines in the nation.
We'll have more with Ross Kay right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap, with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, we keep hearing again the words from the real estate industry. We're in a stable market with home sales really falling. Why are they saying stable market?
They're saying stable market, Jim, because that sounds better than in a contracting, a correcting, or a falling market. The stable market myth was created early 2017 by bank economists in Canada to try to get themselves off the hook. In other words, how is it possible that we come on this show every week and we forecast what's going to happen in the market, and then months or a year later, exactly what we forecast happens? How is that possible? How is it possible that we forecasted last year on this show? Your listeners can go back and listen to the old episodes. That all of the complaints about mortgage debt, the amount of mortgages being booked, the amount of mortgage debt, that was the growth rate of the mortgage debt. We said in this show that was a foolish thing to be worried about because it naturally stops. What has happened now? It naturally stops. So when you hear the comments about a stabilizing housing market, you have a bunch of economists sitting there, housing analysts sitting there, and they're looking at the numbers, and they have no idea what happened. They have no idea why they were wrong with their forecasts. The beautiful thing about today, Jim, is that all of your listeners can go back and check the old forecasts that the banks, the organized real estate, what all of these people put out in the fall of 2017, and see what has happened this year, because they forecasted right to the end of the year. The easiest one for your listeners to look at is the Canadian Real Estate Association, which forecast good sales and higher prices in 2018. They have issued 3 subsequent forecasts since that time, and they have ratcheted down all of their forecasts each time. In other words, they've tried to catch up with their forecasts, and with the most recent one that they're going to release in October, they're going to try to catch up for the end of the year so they don't look at that incompetent. People don't remember to go back and check the forecast that these people made the year previous. So when you hear comments like a stabilizing housing market, that would presume that sales are going to take place on a level playing field, stabilized. In other words, if we're doing 500,000 sales in Canada, we're going to continue to do 500,000 sales. And I'll tell you, listeners, that is impossible, because a housing market either has accelerating sales or decelerating sales. There has never been 3 months in Canadian history where your market was stabilized. It was either accelerating or decelerating. And these trends of acceleration and deceleration are one of the key tools that we use to measure a housing market. This measurement is so precise that that's how we know how many sales are probably going to take place next month, and at what price point those houses are going to sell at. We're within 1% all the time. Sometimes Jim, we would say that there's going to be 45,000 sales or 4,500 sales in Alberta, and it would be 44.98. That's how close it is. At other times, we might be 100 out, maybe 200 at most, but it's always within 1% error. Same as with our price forecast, because it is impossible for the prices to change more rapidly month to month. It's why we say you always have months and months of advance warning of the housing market before it changes. That's also why we say the stabilization comment from the economists is gobbledygook or googly bop, whatever the term is. It just doesn't make any sense. It is a myth. It is not true. It is their way of trying to understand what's happening in a market where they have no training to understand what's actually going on. It would be like me walking into a chemistry lab or a biotech lab and me trying to come up with an answer why when they mix the two chemicals together they get a reaction. Well, I don't know why. I haven't studied that. I'm not an expert. I didn't read the textbook. And in housing markets, that's the way it is. There is no such thing in a real estate textbook called a stabilizing market. So, in my personal opinion, Jim, when a bank allows one of their economists or one of their wealth management economists to make that kind of commentary, I personally believe it's a fraud. I personally believe they should be charged, the bank, the OSFI, should charge the bank for a fraudulent statement because they have nothing to back it up. If they had something to back it up, then our metrics wouldn't be correct. Our forecasts wouldn't be as accurate as they are. We couldn't tell you how to time the market. If the way that they're measuring was true, what we're doing would be impossible. Well, of course, what we're doing is proven every single month. We have people, this housing starts commentary. Go back and listen to us telling everybody that the British Columbia housing market, Vancouver housing market, in the fall of 2016 was correcting. 2 years later, guess what? In the fall of 2016, new homes were not being purchased. Your housing market was correcting. Since those homes weren't purchased, 2 years later, when the builder is ready to build them for the people, because now they've sold out 60-70% of the houses that were going to go in that development, whether it's a condo high-rise or it's a subdivision, that's when you see that the sales have declined because they didn't sell them 2 years ago. All of these things happen months and months or a year ahead of time, Jim. Your listeners, I really hope what they take from the show every week is these things are black and white. You can argue, you can debate all you want with me. You can argue the point, but the sky is blue, the grass is green, the sun is yellow. That's just the way it is. That's how housing markets work. Everything that you're reading about today actually took place is a result of actions that were taking place a year or 2 years ago. We measure those actions so we know it's going to happen a year or two later.
Ross, HELOCs, home equity loans, are they a good deal or a bad deal? There's a lot of conversation about them.
Yeah, Jim, this has been an ongoing discussion for probably 40 years. Certainly when I got into the business back in 87, HELOCs were already an ongoing discussion because of a new investment idea that came out at the time called the Bronfman strategy. Now, the Bronfman strategy was subsequently relabeled the Smith maneuver, I think, a few years later by a mortgage broker. Well, he didn't invent this idea. The world famous Bronfman brothers invented the Bronfman maneuver back in the 1980s. And what that meant is that people would borrow money and invest it in the stock market, and they would take money that they had invested in the stock market and pay off their mortgage. They basically just flipped $1 for $1. But when they did it, they made their mortgage tax deductible. And over a 5 to 7 year window back then, because interest rates were higher, it took a little bit longer, you could rotate your entire mortgage into, so your interest that you paid on the mortgage was effectively tax deductible. You effectively could cut your interest rate on your mortgage in half. Now, I can tell you had hundreds of clients who approached their mortgage borrowing that way and did some version or to some degree or another, tried to implement the problem strategy. Most people didn't stick to it because interest rates were falling and they didn't see the gain. Well, today, when interest rates are increasing, the old Bronfman strategy is a fantastic way to reduce the amount of interest that you pay to the bank, even though Canadians are paying an all-time lowest interest to the banks on their mortgages. You need a HELOC to do that. Now, the wealthy homeowner, part of our wealthy homeowner mortgage platform, we embrace HELOCs. We love HELOCs. HELOCs are a prime way of building net wealth. But what you can't use a HELOC for is irresponsibly. You can't use a HELOC without someone constantly reminding you what the risk is with the use of a HELOC. Because a home equity line of credit can be used in the wrong way. You go up and get one set up, you go through the car lot, there's a nice little red convertible sitting there, you realize you've got $70,000 in your HELOC. They're asking the rental rate or the lease rate on the car is 9%. Your HELOC is at 4%. So instead of getting the lease, you can use the money from your HELOC. That's inadvisable. Or your financial advisor calls you up and says, hey, I got this stock you should invest on. It's a great buy. This happened commonly in the 1990s. And without someone helping the homeowner out, these are the questions you need to ask your financial advisor. These are the questions you need to ask your bank. This is how you need to approach your HELOC. That becomes very dangerous because if you purchase a speculative stock, say Bitcoin or something like that, or the .com bubble, because a lot of people were hurt in the .com when it burst, and they had leveraged themselves with HELOCs in order to participate in the .com bubble itself as it was building. All of a sudden, that money's due and payable. Well, the thing that your listeners should understand is, generally speaking, when your HELOC becomes at risk because you did something foolish with it, i.e. invest in a .com bubble, the overall economy is in trouble. The economy itself is in trouble. And when the economy is in trouble, that's when your banks start to look at you in a different way. They were happy to let you have that HELOC for the last 7-8 years. All of a sudden, their risk officer at their bank says, hey, our HELOCs are a little bit high. We better do something. And they can start calling in these HELOCs. The consumer needs to understand there are ways to protect yourself from that. It's not complicated. It does entail looking at things truthfully, rationally. It does entail contacting a lawyer or an accountant to be sure that the advice you're being given is correct, that whatever documents you're asked to being signed are in your best interest. Yes, that's true. You can't just trust anyone. That's including whatever advice we give in the wealthy homeowner. We don't say take our advice. We say take what the advice we've given you and go talk to these people and have them disprove what we're saying. And HELOCs are a case in point. HELOCs are a great tool for every Canadian homeowner. There is no reason for a homeowner to have to get a reverse mortgage when they're 65, 70 years old and retiring, when instead they can get a HELOC. There is no reason for people to want to be able to invest in an investment property. So that they want to buy another piece of real estate and not use a HELOC, home equity line of credit, on their own home to get that started. But when you do that, you have to do it in such a way that you're protected. It's not the bank we want to worry about protecting. It's not the financial advisor you want to protect. It's not the mortgage broker that you want to protect. It's you. You want to protect yourself. So prudent use of a HELOC, even when you maximize the HELOC, take the HELOC out to its max. which we say, you got to be careful because we always say you've got to hold back 6 to 12 months HELOC payments from within your HELOC. But that said, when you look at it that way, you see the problems that the economy can bring to the Canadian economy and to net wealth when other people start to say, oh, we got to withdraw HELOCs from Canadians. We have to implement new rules to reduce the size of the home equity line of credits. We have to change the rules so that the regular Joe out there can access a home equity line of credit. Instead of doing just the opposite. Oh, we'll continue to loan home equity line of credit. The only thing is, we are now going to hold the people who are advising, or the banks who are lending, or the mortgage brokers who are registering accountable for it. This is no different, Jim, than the B20 rule from the OSFI and all the false blame that's been labeled on it by so-called mortgage experts and housing analysts. The B20 rule is a falsehood. The OSFI instituted a lower gross debt service ratio for Canadians. That's all that happened with B20. They did that because the rules that the freedom they had allowed the banks was being capitalized on the banks, exposing the bank customers to more risk. All we need to do is approach everything that you do, whether you're a homeowner or a tenant, with your own interests at heart. Look at yourself, your own situation. Look at the risk that you're open to. Are there ways of mitigating that risk? Are those ways in tandem with how you look at life? In other words, if you're going to be a tenant and rent, believing you're going to be able to save enough of your income to equal that of the forced savings that home ownership makes you do, then have that conversation with yourself. And if you believe in it that much, I believe you should go out and borrow the investments and pay interest payments on those investments from the day one. Because what I can tell you is this: watching thousands of homeowners over decades and decades, our data shows there is no way to build net wealth like home ownership. I don't care what any financial advisor says. I don't care what any bank manager says. I don't care what any politician says. Home ownership is the root of the net wealth of this nation. So home equity lines of credit, Canadians better do everything in their power to be sure that we're electing politicians that enshrine our ability to access equity that we have in our home to be able to use it for other purposes.
Ross, thank you so much for being on the show.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. You can find us on Twitter @HouseStreet. I'm Jim Goddard. Thanks for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.